You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. The Advisor's Option is also brought to you by Northern Trust Capital Markets, offering a unique blend of transparent trading, quality execution, and smart liquidity solutions across institutional brokerage, transition management, securities lending, and foreign exchange. Northern Trust's options offering includes quiet access to non-traditional pockets of liquidity with hands-on support from experienced traders to customize your trading strategy, combined with the peace of mind that comes with trading through a stable and globally respected firm. To learn more, contact John Cherry at John_Cherry, spelled like the fruit, at ntrs.com. or visit northerntrust.com/capital markets. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. Welcome back to the Advisor's Option, the program here on the old network for you, the busy financial advisor or asset manager who's wondering, how do I dip my clients' toes into those dark and stormy options waters, or maybe you're already using them, but you want to learn how to use them more effectively. Either way, we've got you covered here on the Advisor's Option. My name is Mark Longo from the aforementioned network, and I'm joined by a cavalcade of stars here to help me break down the world of options for you guys. Let's go around the dial, see who's joining us today on the program. Let's start all the way out in the hinterlands of, I believe, New Hampshire, even though he moves quite rapidly, so it is hard to know for sure. We are joined by Matt Amberson, the founder and principal over there at ORATS, a.k.a. Options Research and Technology Services. Matt, glad we could lock you down for an hour to have you join us on the show today.
Mark, great to be here with this great cast. Looking forward to it today.
It is a great cast. Let's see who else we have joining us. Let's move that dial around again, down into the Atlantic, all the way out to a little island known as Puerto Rico, where we are joined once again by Chris Hausman, the portfolio direct manager and indeed the managing director of risk. I've said it many times, I need a director of risk in my life, so Chris gets bored there. He can always come be my director of risk. Meantime, though, he's over there at SWAN Global Investments. Chris, welcome back to the show, sir. How are things in the land of directing risk?
Well, it's going good. Thanks for having me again. And I like to think that I'm more in the Caribbean than the Atlantic.
That does sound more exotic, doesn't it? Because Atlantic could be, right outside Long Island Sound. It's not quite the same degree of exoticness, to coin a phrase there. And then rotating that dial all the way back here, right close to the studio, not quite, right down the street here, where we are joined by John Cherry. He is the global head of options over there at Northern Trust Capital Markets. John, welcome back to the program, to you as well.
Thanks, Mark. Happy to be here.
All right, should be a fun one. Let's get to it. We have a lot of interesting topics to discuss, but it is an interesting time out there in the marketplace. So we a lot of things going on in the broad market. A lot of people looking at valuations, whether they should get short, whether they should get long right now. So we thought it's a good time to break that down and how to use options to do just that. So it's time for our Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody. Welcome to Options 101. Like I said earlier, these are interesting times. Obviously we're recording this right now. We're on the heels of a couple of days worth of rally. So some of that fear, some of those concerns have been alleviated. But coming into this week, things were looking fairly dire. We saw massive plunges across most of the broad equity indices for the better part of the weeks preceding this one. We saw the PE multiple of the S&P just get annihilated. In fact, Bloomberg retracts such things. They put out some interesting data. We'll include that in the show notes for you. But they pretty much said, as long as they've been tracking this all the way back to 1991, they marked the largest years that marked the largest drawdowns in terms of PE. And of course, that's another way of saying largest sell-offs effectively in the stock market. And 2002 is their number one, which was close to 30-odd%, close to it. Again, these are changes in the PE ratio, not the pure prices of the S&P, changes of the PE ratio. So nearly 30% sell-off in 2002, followed hot on its heels by, you probably guessed it, 2008. Not a great year for the markets there either. That looks like about 18%. But this year, coming into this week, we were hot on the heels of that at 2018. It was about 17%. a reduction in S&P PE. So that's pretty much 1% better than 2008, which is not saying much because 2008, of course, was a very, very dire time. So I'm sure a lot of you guys out there listening, and I'm sure a lot of you guys on the show with me today, have clients and customers and people calling you up and saying, hey, you know, what's going on with these markets? And also, should I be getting long? Should I be getting short? And if so, how can I use options to do just that? So we thought this was a great time to kind of do an overview of that. And of course, when we're talking options and exposure to the underlying, we're going to really be focusing on one Greek in particular. That, of course, is Delta. Maybe, John, we'll start with you because I believe this was kind of your brainchild, this segment here today, this topic at least. So maybe let's start off. We talked about the Greeks obviously many times on the show, but it's worth doing a little bit of an overview. Give our listeners a little bit of an overview of Delta, you know, what it means, what it's used for, and also if you want to throw in any color, maybe anecdotally on what you're hearing from clients. Are they asking to get long? Are they asking to get short? In aggregate, what are you hearing? You know, feel free to do that as well.
Sure, happy to. I wanted to, particularly excited to talk about it with you guys today, and certainly the audience, just based on having Chris and Matt here as well. And the reason for that is because, you know, the use cases of options within portfolios, particularly looking at institutional investors, is really something that we focus on here at Northern Trust. And so it kind of breaks down into really four categories of what clients are using and how. Protecting clients' portfolios over long-term bull market, which is obviously something that we've seen within the marketplace over the last decade. Increasing income from investment holdings, and then kind of improving overall risk-return profile on a risk-adjusted basis. Some of the option strategies that are most commonly used amongst investors tend to be covered calls. That's kind of the simple one. Covered call for the broader audience is the type of option strategy where the investor writes call options on the underlying stocks or ETFs within the portfolio. Typically, options are priced out of the money so the portfolio manager and or investor themselves can balance the income received against the probability of the stock being called away. A couple other common ones that we see, protected puts, which have been wildly popular for investors over the last 5 months or so. Strategy involves clients being long the underlying stock or ETF and purchasing a put option at or near the money. The investor then can lock in gains while maintaining upside exposure of that underlying asset or sector. Short puts, which tend to be relatively popular in periods of increased or outsized volatility. In that type of scenario, the investor sells puts on stocks or ETFs where they have a favorable opinion. If the stock price rises, the investor keeps the premium. If it falls, they may be required to purchase the underlying stock having that type of obligation. And then lastly, and we won't go into detail on it, is it being long callers. Long callers have the ability to maintain downside exposure while being funded by having that short call position.
And I'm sure our audience is interested. They're always taking the pulse of people in times like this. I'm sure you're getting a lot of calls from people over there at Northern Trust these days right now, looking at different opportunities in the marketplace. In general, maybe in aggregate, you think people and people you're interacting with, are they looking at this as an opportunity to get long more and maybe pick up some more equities at these more, as I mentioned at the top of the show, kind of improved valuation levels? Or are they maybe the latter? Are they a little bit spooked and trying to dial it back a little bit? What maybe in aggregate, what kind of stuff are you hearing over there, Jen?
Yeah, it depends on certainly the client type. When you're looking at kind of our core client being a family office type or foundation or an endowment, those type of clients in general have a lean to be more hedging. And so certainly in periods where the market is up on days like it is today, we certainly see an increased level of opportunistic put buying, both just straight puts and or put spreads occurring. But then when you look at more of our investment manager type client, they're more taking advantage of periods where we're looking to short puts on days that the market is down significantly.
And Chris, maybe similar questions for you. First off, if you have any, anecdotal or aggregate kind of interest or feedback you're hearing from, your clients over there at SWAN, the people you're engaging with day in, day out, either on the phone or maybe at some of the 10th Box educational events and others, are they seeing this as an opportunity to get themselves and indeed their clients more equity exposure? Or maybe were they spooked by these recent resurgence of volatility and maybe they're dialing it back a bit? And then B, kind of the point of the segment, of course, people here listening are obviously looking for ways maybe to get themselves and their clients a little bit more long equity exposure, maybe a little bit less. So maybe we'll start them with some. John kind of gave us a good overview of a whole bunch there. Maybe we'll start really, really basic and just hit on the basic kind of long call, long put, and kind of the use cases for those as well to get long and short. So wherever you want to start, a lot to unpack there, Chris.
Yeah, I mean, there's definitely been an interest lately in hedged equity. I think there's been a lot more talk of slowdown in the economy the second half of 2019, and you're starting to hear a lot more recession talk in 2020. I think some of the larger houses are actually starting to lower their 2019 year-end projections. So there is a lot more interest in equity replacement via the options market. Your basic traditional synthetic would be buy, call, sell, put. I mean, that has some pluses and minuses. It's just going to have underlying equity. But I think if you're dealing more with protection, buying put spreads is a good way. Traditional hedged equity, such as protective puts, which John mentioned, is a really good way. Even though, we talked about a little bit about volatility being elevated right now, at least definitely compared to what we went through in 2017, what's super, super on the low end right now, which is surprising, is skew. And again, skew is basically the difference between downside volatility and upside volatility. So if you can construct some type of hedge right now that is vega or volatility neutral, and you can actually be a buyer of skew, right? Buyer of that downside volatility versus a seller to the upside volatility. That could be pretty promising right now, because usually the last few years during the rallies, skew has been very elevated. And now with the sell-off, it's just gone the opposite with the increase in volatility. So anything where you're buying downside put, selling upside call, and if you can do that volatility neutral, that has been lining up quite nicely over the last month or so.
Speaking of lining up nicely, obviously these are interesting times for you guys over there at SWAN, the DRS. These are kind of the environments it was designed for. Prolonged, protracted sell-offs are periods where, of course, the DRS tends to outperform. How have things been going over there? I know you probably have been busy, managing the long-term puts against the near-term calls and puts. How are things been going in DRS land over the last month or so?
No, the sell-off has definitely helped. As you know, we have an equal weight approach that has been outperforming during the sell-off. It's getting close to the end of the year, which is kind of when we start thinking about rehedging and reestablishing our put for 2019. So we have clawed back some of the underperformance with the sell-off. It's definitely not a bear market yet. And as you guys know, the defined risk strategy is really not judged over a 1 to 2 year period. You need a full market cycle to really get a better feel for it. So it has helped, there's no doubt, but we're not still getting that, this is still under correction land. I mean, we're still under correction territory, not quite tipping the scales to get to that bear market where, you will see the protection kick in and that outperformance kick in over a full market cycle.
It's funny. You roll the puts every year, but since we pretty much wiped out most of the gains for the year this year, you may not have to do much rolling on that put. It's probably close to at the money again, Chris.
Yeah, it definitely is. So we're kind of like right at that tipping point where it's like, nobody wants markets to go down, right? I mean, we want them to go up eventually, but you have to hedge those periods. You have to hedge those potential big losses that could happen, because that's really that's the destructor of any type of portfolio, is taking these big losses. So yeah, we're really teetering on the at the money-ish right now, because markets are essentially unchanged for 2018. So I think we'll be in a good position right now to rehedge towards the end of this year and see if we continue selling off in 2019.
Yeah, the director of risk can take a year off. You don't have to roll. You're done. You can go home. You're good.
All right. Well, you can tell Randy that then.
No more risk. No more risk on the table for you for the rest of the year. It's done. You're good. But Matt, same question for you. First off, kind of anecdotally, what are you hearing from the teaming masses out there and the clients out there who are obviously reaching out for you for back tests and analysis and a bunch of other things you guys do over there at ORATS? Are they like the others we're hearing, kind of taking the opportunity to maybe increase their exposure, or maybe are they a little spooked? and heading for the hills. And then also B, you guys are kind of the keepers of the data over there at ORAT. So if you have any thoughts on kind of some of the more basic strategies people can use just to get very basic, long short equity exposure in terms of getting long calls to get long deltas, long puts to get short deltas, and then we can always dial it up from there and talk about more advanced. But we'll start with the basic stuff first.
Yeah, definitely. I'm getting more calls now about our technical indicators, are using the option market to get some sense of what is going on out there. People are confused. Is it going to go? Is it going to bounce? Is it going to go down? Our numbers still are pointing to there's a lot of risk out there, pretty negative on the market. It's not back to those kind of we have a measure of what's called contain and go and backwardation still. In backwardation, at least in the short term, so that's pretty risky out there. So that's what we're talking to clients, not only option trading clients, but long short funds that are using option information in their trading of stock and equities. As far as the strategies, as I'm apt to do, I back tested all of the things that John and Chris were talking about, just to see how since 2007 they've performed, just kind of the basic strategies, buy rights, maybe just a long call replacement, or a long call and a short put. The top performer is the buy right, owning the stock and selling like a 30-day 30 delta from a Sharp and from an annual return. Second place and pretty close was the short near-term put and long 1 year call, about a 75 delta call. So we look at these types of strategies. We back test them. The poor performing one is kind of an out of the money call. So if you're gonna buy a call to replace stock, what our back test talks about is one that's longer term. And the more in the money, obviously this it's rallied quite a bit, but at least that kind of gets you a synthetic put protection way down. So, Mark, that's what we're seeing.
It doesn't surprise me that the buy right would get a little action, a little bit of love here. And the short put, obviously, its synthetic equivalent would be up there as well. You talked about the stock replacement. I think that's a good segue into a little bit more of the advanced stuff. Really quickly, just a real quick recap of some of the basic stuff. If you're looking at your clients, you say, hey, how do I basically get exposure? Remember, we talked about delta. Delta is, of course, your option sensitivity to the movement of the stock price. If you're not familiar with the Greeks, I encourage you, again, go get the very, very early episodes of this program. We broke down the Greeks extensively. Also, our Options Bootcamp program does that as well. So got you covered on the Greeks. Of course, our friends over there at OIC have a lot of great education over there, optionseducation.org. You can get a full overview of all things Greeks if you are indeed so inclined. And remember that quick rule of thumb for delta. Of course, at the money is going to be about 50, somewhere in that range. In the money is going to be somewhere above 50, and out of the money is going to be somewhere below 50. So just keep that in mind when you're looking at how much delta exposure you want to get for your client. So basic things like buying at the money call is going to get you somewhere around a 50 delta. For long for your client, buying at the money put somewhere around short 50 deltas. Remember, puts are short. And you kind of go from there. You mentioned kind of the short put, obviously, too. That one's a little bit counterintuitive for some people to first wrap their heads around because you're selling a negative delta option. Therefore, you're getting long deltas. I know, basic math, it's hard. But it's another way a lot of people like to use. And as Matt pointed out, it has been performing fairly well of late. So if your clients like to work, I'm sure they're familiar with, and you're probably familiar with as well, working by limit orders in a long equity, to get long equity, I should say, then a short put is a great way to get paid to work those orders as long as you're familiar with the risks inherent there. And also you're writing the put at a level where you or the client are indeed comfortable to get long the stock at that level. Then that's a level where you should be writing puts there. Chris, you have some thoughts here on delta before I move on into some of the more advanced strategies, sir?
Yeah, just real quick, it's always helpful for another interpretation of delta, especially for people who are coming from the stock world and they really don't have a lot of experience with options. I mean, delta is kind of like the beta. So, I mean, there is a limit for delta, which is 100, like you already pointed out. But I think, what people, if you have a stock background and options is brand new to you, think of delta as just the beta, and that usually helps people understand kind of what delta is supposed to do.
A lot of people also throw around that delta is the probability of expiring in the money. It sounds good. It looks good. It makes intuitive sense to a lot of people, and you can understand why an at the money would be a 50, because that is effectively a coin flip. You're ticking around all the time, whether it's going to be in tick in the money, tick out of the money. Problem is, it's not technically true. There are many examples where the delta is not going to give you the right probability for the at the money. So it might be a decent shorthand for it. You could probably assume if an option is out of the money, it probably has a less than 50% chance of expiring in the money anyway, and maybe vice versa for an in the money, and somewhere around that for at the money. So it's not a bad shorthand for the probability, but I won't go out on a limb and say it is, because that is not technically the case. But if you're confused, or if you want another way to maybe make delta a little bit more intuitive to you, then that is perhaps a way you could think of it as well, just with that caveat in mind. Let's step things up a little bit. Let's go, and even though it's called Options 101, let's maybe go a little bit Options 102 here and get other ways you can get a little bit more advanced ways to get some, let's start with bullish exposure to the underlying. One of my old favorites, is old standby, is the old bullish risk reversal. It sounds scary, but it's really just combining two positions you're probably already very familiar with right now as well. We talked before about the short out of the money put. We're going to start with doing that. You're going to sell an out of the money put here. And then also you're going to turn around, take those credits you collected from that short out of the money put and use them to buy a long out of the money call. And what does that get you? You're getting short negative delta. So you're getting positive delta on the put. You're buying more positive delta. So you're getting positive delta exposure on this. And this, how is this better than just doing the other positions outright? Well, for example, you're selling the out of the money put. So that gets you some credits. It gives you also, of course, the same risk as selling out of the money put. You might buy the stock at that level. So as long as you're okay with that level and you identify a level you're okay buying the underlying at, then selling that put is an interesting way for you to go. And of course, using those profits, or some or all, depending on your choice and how you structure it, you could turn around and use them to buy the calls, depending on the product. A lot of times in the equities and the indices, the puts are going to be richer, so you'll have probably still a little bit left over if you're buying calls, because volatility-wise, the calls are usually at a discount. But that's depends on the product you're trading and how the skew lines up out there. But in general, bullish risk reversal, if you sell a typical use case is selling a 25 delta put, buying a 25 delta call. So effectively a 50 delta risk reversal. So by doing that, you can see some of the benefits of that, listeners. You have now a position that is effectively the equivalent of half of having 100 shares of stock, and you've done it with little to no outlay. You have some risk, you have some capital you have to tie up for that short put, so it's not a completely free lunch, but there is a way you could use that to get a little bit more nuance, and you have a decent amount of exposure to, and you can obviously play with that a bit. You can get more than 50 deltas, you can get less than 50 deltas, whatever your desire is, but that's a good way to, of course, establish long equity exposure with very minimal capital outlay, which capital efficiency at the end of the day is the name of the game. Matt, do you have some thoughts here on our old friend, my old friend at least, maybe it's yours too as well, I don't know, as the bullish risk reversal?
Yeah, I'd like to echo something that Chris said and apply it to the strategy. The put-call relationship, the low strikes to the high strikes the low strikes are extremely cheap compared to history, and the high strikes are quite rich right now. So this strategy, what we'd likely recommend is to move out to a longer term. The short term, with this correction that we've seen, has really flattened the skew out. And this type of a strategy that might not be the greatest time for it, based on that extremely flat skew, especially in the S&P related options. And this type of strategy won't benefit from that, Mark.
Yes, it's a rare scenario, but it does exist. It does happen where the S&P puts are not quite as juicy, not quite as big as they usually are versus the calls. And this is one of those times, you're right. So when these scenarios rear their ugly or perhaps nice heads, depending on which way you look at it, the risk reversal is more or less useful and user-friendly for your clients. So long as you bear that in mind, you're taking advantage. This is a skew trade. Now, risk reversal is kind of swapping your risk on the skew curve there. So this is a skew trade. So the skew has to be favorable for that. So if you're not familiar or you don't really comfortable with using terms like skew when you're talking to your clients and don't understand them yourself, then maybe the risk reversal is one you want to avoid. But still, it's a great one. You maybe also be more familiar with the term collar, which is kind of just flipping the script. That is effectively a bearish risk reversal. It's usually done with stock. So you own stock, you're buying a put to hedge it, usually an out of the money put, and then you're selling an out of the money call to also not just sell your stock at that level, but also finance some of the protection of that put. We talked about the collar a million times on this show. I've often jokingly referred to it as the holy grail position for advisors out there, because so many advisors are looking for ways to protect long equity, and collars are a great way to do that. But you can do the collar without the stock, in which case it's just a bearish risk reversal, which means you're buying out of the money put and you're selling out of the money call. The same thing we were talking about before, just flipping it. So now you're looking to call to finance the put, and you're looking obviously to getting short delta exposure here. You want the underlying to drop, so you're talking maybe somewhere in the negative 50 range for a typical risk reversal, and obviously you can play with that many different ways. We've talked about that before. Typically, when you're doing collars or any sort of risk reversal, collars in particular, people like to try to get zero cost ones. And I'm never usually a huge fan of those, because it means usually you're kind of trying to keep them in the same month, and you have playing with strikes you don't really like. Obviously, we've talked about before, if you want to maximize the theta and all the different things that go into these options, you want to maybe push the long leg a little bit farther out to decrease the exposure to theta, keep the short leg as close to expiration as possible. So that requires a little bit more busy work, a little bit more work on your part for the clients, but the end result can usually be a lot better. And there's great studies, if you want, that we've talked about before on the show, on collars. The OIC has a great one. It's a little dated now, but the data is still valuable in the underlying, in terms of they looked at collars across a broad variety of underlyings, not just equities. Again, and you can take the collar without the stock, just look at the bearish risk reversal itself, and the analysis is still the same. John, any thoughts here on using risk reversals? Are you a fan of risk reversals for clients these days over there? I mean, maybe not in this skew environment, but maybe if you have any thoughts just in general about the utility of using a risk reversal to get long or short stock for your clients, have at it, sir.
Yep, risk reversals are very popular here with our clients at Northern Trust. On the bullish side, they tend to be prohibitive as far from a capital tie-up standpoint, so we don't do many kind of bullish risk reversals. But on the collar, so looking at bearish risk reversals, they are wildly popular for our clients for all the reasons that we've discussed so far. I mean, you have these long positions that you want to stay invested in, and opportunistically looking to hedge the downside. Everybody wants to kind of hedge the downside opportunistically, but nobody really wants to pay for it. And so the ability to have a costless collar solution put in place on a customized basis, it makes a lot of sense for many of our clients. So, Mark, you mentioned it quite eloquently, to be able to do kind of the cheaper put, regardless of skewed, looking to be able to do the quote-unquote cheaper put and be able to get creative as far as the financing mechanisms that you're using on the short call side is something that we see quite often for our investors.
Yeah, I think that's a great way to proceed. Obviously, if you're new to collars or new to any sort of these risk reversals, and obviously keep it simple. But as you get a little bit more sophisticated and understand them a little bit better, starting to play with the legs a little bit, I think is a great way to go. I'm sure Matt has a legion of back tests on just what's the most effective way. Again, the data from OIC, they kind of settled on buying the put about 6 months out, and selling at the time was a monthly call. I don't know if they've updated it. I don't think they have, to include weeklies. Weeklies might give you a better bang for your buck, but then again, you're doing 4 times as many calls per month. So that may be off-putting for some advisors in terms of a time investment. Maybe monthly is the best way to go. But if you start playing with those legs a little bit, then you'll have obviously even better returns. Let's dial it up a notch yet again. This is another strategy we talked about on the show before, but it's very, very, very well suited to the market environment right now. And Matt and John have both referred to it already. This is indeed our old friend, the stock replacement. If you're looking to get stock exposure, you can't go much better than direct stock replacement. What is this? You have stock in your portfolio. You're going to get rid of that. You're going to sell all that. Get rid of all that pesky stock. We don't want underlying here. This is an option show. And then instead, we're going to replace it with options. Why do we do that? Bunch of different reasons, but we talked about the Greeks. Now you have all the Greeks working for you. Where in the past you have stock. Stock is pretty much just a delta game. That's all stock really is. But when you get to options, you got Vega now, you got Theta, all these other things that are working for and sometimes against you as well. But in this case, they're mostly working for you. You have the Greeks now, so you're buying it. You place that stock with a longer term, usually 6+ months and beyond, maybe out to a year or two, depending on your time horizon, what you like, and usually going in the money. So again, we're talking about options that are higher than 50 delta options. So probably, it depends. Again, this is a very user-dependent type structure, but somewhere probably north of 50, probably 65 to 75 seems to be the sweet spot for a lot of people. But again, your mileage may vary. Somewhere around that range of buying that type of in-the-money call, anywhere from 6 months to 2 years out. And now you have a position that's going to be much more capital effective because you're buying options, obviously, are a levered instrument. So you're going to be saving some of that capital. So that's already a benefit right there. B, now you mentioned before delta. So you have an option that is going to be fewer deltas than 100, so it's not going to move one-to-one with the stock. It's going to cost you a little bit on the upside in the near term, so you miss out a little bit there. But on the downside also, if the stock drops, you're not going to lose as much. Also, if the stock drops precipitously, you're going to have volatility kick in, which will help to slow down that rate of loss. You're not going to make money, but you won't lose money as quickly as if you own the underlying. So to the downside, this position is more favorable. It's also, again, more favorable from a capital efficiency perspective. Now, and the downside, of course, is that it's kind of a little bit more time consuming. You have to babysit it a little bit. And then, of course, if you want to get even more advanced, definitely at the options 103 realm, you can kick this up a notch. I've heard this strategy called many different things. Synthetic covered call, a poor man's covered call. Our friend Brian over there at Ally likes to call it the fig leaf on the show he does on the network every week. This is effectively taking that long-term in-the-money call you just bought and augmenting it with a nearer term. It's not quite a covered call, which is why it's called synthetic or a poor man's covered call, but it kind of acts like it. You're selling a near-term call, out of the money call now. So you have a long-term in the money call, and then a short-term weekly or monthly out of the money call you've got. So you effectively put on a diagonal spread, and that sounds terrifying to you. You may want to stay away from this position, but this is a great way tonight because you spent that money to buy the call. It's going to be expensive. It won't be as expensive as buying the stock, but it's still going to be expensive. Selling that nearer term call repeatedly every month or every week, and depending on your preference, will go a long way towards reducing that outlay over time, and you can see the benefits from that over time here as well. So there's a lot to unpack with these two. Matt, maybe we'll start with you because you just touched on stock replacement earlier. This is a strategy that has a lot of different ways you can play with it. It's suitable to a wide array of clients. You can even get super advanced. You can go pure 100% stock replacement and go pure synthetic. So sell a call, buy it, put on the same strike. Now you got effectively short stock or vice versa if you want to get long stock. A lot of ways you can go with stock replacement, sir. But Matt, maybe what are your thoughts on this very, very strategy, a great strategy you can really dial in for a broad array of clients, I think.
Yeah, well, how about this, Mark? So you buy your long call way out, maybe a year out, 70 delta, and you sell your call short term against it. So that works pretty well. But then you could, in order to replace it with stock, you could still sell a put, and so now you have a long call, short put, short call, and that's actually, there's a bit going on there, but that's actually the best performing out of all these things. So I just wanted to throw that in if you want to get. Are
you selling the put? You're talking a longer term put? You're talking like, and maybe in the same month you're selling the call. Where are you selling the put?
No, I'm selling the put short term. So you get the short term sell there. You get the short term sell and the long call. The short term selling call, but then you buy the long term call, and that's kind of the stock replacement buy right. I'd call that potentially.
Stock replacement buy right. I like that. See, there's so many names and so many flavors for this strategy, and I do like that. That you kind of blew probably some of our listeners' minds right there because now they got a short strangle, they got a long call. They're like, what do I got going on? This is crazy. But you're right. That is an interesting way to augment that. I would have to wager that the director of risk himself may have some thoughts on that exact scenario. Chris, I think you may have some experience with managing near-term short strangles, sir. So what are your thoughts on stock replacement in general, the basic, the more advanced, the even more advanced version that Matt just laid out? And if you have any thoughts therein and their suitability, have at it, sir.
Yeah, I just wanted to throw a couple of other strategies out there. I mentioned this before on the show that people use call spreads as stock replacement. So on top of that, you can sell an additional call, which is almost like a buy right, and that's called a call ladder. So the problem with that is you don't have actual underlying. It's a call spread versus a short call, so it's a more advanced type strategy where you have to make sure that you don't get assigned or anything like that. And I do want to throw out one additional one, which is called a call Christmas tree, which is kind of like a variant on a butterfly, where let's say you buy an at-the-money call one time, you skip over a strike, you sell 3 calls, and then you buy 2 calls outside of that. So I thought that would be appropriate for bringing up the call Christmas tree. That's a limited limited risk strategy gives a little bit more room on the front end where the call spread is. And then you can usually collect a little bit of premium by selling the 3 calls in the middle versus the 2 calls on the wing.
Called Christmas trees. We have so many flavors. So listeners, you're getting a smorgasbord here of all things stock replacement and just getting how to get long deltas if you want. There are so many ways. We could spend many, many hours talking about the various ways. Instead, John, this whole segment was kind of your idea. So maybe I'll give you the beginning of the final says here in terms of if you have any thoughts. Let's start on stock substitution. We've already laid out many different flavors therein. What are some of your preferred ways to implement stock substitution for your clients? And then B, if you have any final thoughts on just the whole getting long, short equity using options, have at it, sir.
Sure. Yeah. I'll tell you, one of the privileges of sitting in the seat that I sit in here within like a fully disclosed agent, broker, dealer is exactly what we just kind of covered. I have the ability to speak with asset owners and asset managers of high levels of sophistication every day. And so kind of hearing how the best view, express views within the option space is I really kind of get to see it all. One strategy I would like to highlight though is truly, and we touched on it, kind of danced around it, is on the single stock side, doing opportunistic buy rights. We see quite often asset owners and asset managers, long-only shops, taking position in a single stock security and selling an in-the-money covered call based on fundamental views that they may have within the single stock space. In periods of increased volatility that we're seeing kind of the second half of 2018, there's certainly single stock vol is ripe to be able to take advantage of some of those opportunities, especially in stocks that have questionable dividend structures.
All right, I lied. Matt gets the second final word here. I know you have some additional thoughts on your new. I'll have to play around with this one a little bit. I haven't played around with this one as much. I know I've done a lot of the, AKA fig leaf type strategy, but not your as you're referring it, the stock replacement buy right. If you have any final thoughts on that, sir, have at it.
Not on that one, but John brought up one of my favorite topics is the single stock buy rights. So you have a portfolio and there's a lot of opportunity there. And that's where the data really comes in. You have to watch out which ones you're writing on. We have quite a bit of back testing on that. One of the things is avoid the conferences. If they're going to be speaking at a conference, avoid earnings. Look to some elevated volatilities, and then those present some really good opportunities in the single stock world. Just looking at, because those volatilities tend to move around a lot more than the indexes. That's just my quick comment on the single stock buy rights, Mark.
Speaking of moving around, we got to keep moving ourselves as well into a really brief edition of The Buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, everybody, welcome to The Buzz, where we cover some of the hot topics from the world of options. Maybe you missed them. You're kind of busy out there dealing with your clients. We get it. That's why we're here. And let's kick things off. This is options, and just a lot of you out there when you're managing for your clients, a lot of them are interested in, or they have questions about, they want to trade, maybe you want to trade during earnings season, but you have a lot of questions about, should I buy premium, should I sell premium, what's volatility, how does it perform in this name over time, etc., and so on and so forth. And that's why we have Matt here. He's the man with all the answers on these types of things. The guys over there at ORATS really put out some great reports, the earnings move and the earnings move results reports. We're happy to have them featured on the Options Insider all the time. So hopefully you guys have been checking them out throughout earnings season. Matt, earnings season's kind of winding down now, but we still have some big names reporting. I'm just curious for you guys, as you guys are kind of the keepers now of the earnings data out there. It's been an interesting season, a somewhat volatile one, not all driven by earnings, but a lot of it. And what are some interesting thoughts for our audience on what you've seen this season? Maybe any surprises, any interesting takeaways, any things that really kind of caught your eye as you guys have been crunching the numbers for literally thousands of names this season? Mr. Matt, I think you're pulling an Andrew on me, sir.
I did indeed, but I was giving you credit.
Oh,
so
I'll take. That's why you muted yourself. All the praise and you mute yourself. I get it.
It's been a crazy earnings season. We're about 800 stocks reporting of 1,000 that we cover for this, and the volatility has been so elevated with just the general market that it's really changed the whole landscape here. So whereas usually you could sell and get a win rate of 60%, now it's only 55%, which seems strange. And buying the straddles this earnings season has done better than in recent past. So that's the biggest change. The ORAT's projected volatilities and undervalues and overvalues has done decently, but we haven't done as well as in past quarters, just because it's been so strange with the volatility so large in some of these strangles are just so much larger than usual. That's about it, Mark.
One other thing that's kind of interesting, maybe we'll touch on it really quickly outside of earnings really quickly. It's kind of an in-the-weeds headline, but an interesting one. John, I'm probably sure this was exciting to you guys and certainly your clients maybe over there at Northern Trust, who sling a lot of index and maybe options on index ETFs. FINRA a month or so ago proposing higher position limits for ETF options contracts. Some of the big ones you're probably familiar with, Qs and SPY, et cetera. Russell, of course, 2000 in there as well, IWM. The justification for that being that, of course, these indices are, they're subject to maybe a little bit more onerous rules than the other indices and other products out there should be. And these indexes don't have the same degree of risk that some of these other products do. So they should have. Plus, people are using SPY to replicate maybe SPX positions or other things out there. So they want larger position sizes to be able to do that and trade effectively. And so FINRA saying they want to do just that and increase the limits. They put this, I believe this is still in the comment period. Now, I think I had a 60-day comment. I think that's coming to an end soon. But John, this has to be exciting news for you guys at your desk, as well as maybe for your clients out there. Again, this is a little bit inside baseball, but still interesting stuff. Are you guys excited that maybe no more position level limits, or not no more, but higher position limits? It's not a free for all, but it's higher position limits on some of these ETF options, because there is a lot of institutional flow in these, and they want to be able to get off larger trades. Is this something that's been on your radar, John?
Yes, indeed. I mean, I send out a fair amount of stuff myself and the team sent out to clients, and this information couldn't have gotten out to clients fast enough. And some of the responses that we received back from clients was, about time. This is a welcome change, certainly a welcome change for the industry. Should it get pushed through? The fact that it is kind of coming from FINRA, I think, is outstanding. So it's not just coming from market participants such as ourselves, because we've been certainly requesting ad nauseum for this type of change. And it really does kind of boil down to is when is truly supply and demand. I mean, when you're looking to trade institutional ETF options and you're looking to do it on an agency basis, where we're going out and searching for liquidity, and you're running into roadblocks on position type limits on broad-based ETF options, it really does limit the pool of liquidity of market participants that you're able to quote trades with.
Again, this is a little bit of an inside baseball headline, but if you're out there managing money for high net worth individuals, or perhaps a lot of funds you might work with, this is something you might bump up against. So it's a good thing to hear that FINRA realizing that and taking some steps to address this. Speaking of addressing things, you guys send us a lot of great questions. We try to get as many of you on the show as possible. So without further ado, let's do just that and dive right into the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, let's get to it. Lots of great questions here. First off, we got one here from Charles Vera. He says, greetings, AO crew. He puts in parentheses, Mark, Chris, Matt, Eric, and new entrant John. Look at John's been on the show one episode, and he's already getting mentioned in the mail. Look at that. He says, love the show and have been listening for over a year and have caught up on most of the back catalog. Well, good for you. You're clearly, Charles, a man of very discerning taste. He goes on to write, I have two questions, one options related and one somewhat off topic, but I just wanted to pick your brains. First question, how much capital should I plan to set aside when selling puts for my clients? I'm looking at selling 5 to 10% out of the money SPY puts on a monthly or tri-monthly. Oh, that's an interesting range, 1 to 3 months. That's a big gap there. On a monthly or tri-monthly basis. But it seems like the margin requirements for this strategy are all over the place. Do they just vary by broker, or is there some rule of thumb that I should consider when tying up capital to sell puts? And the second question is, do you think the recent market volatility will cause the Fed to reconsider its roadmap for raising rates in the near future? There aren't too many other developed economies that are putting the brakes on like the U.S. right now. Thanks again. Really appreciate all that you guys do. Well, a lot to unpack here. The first question is one we get flavors of that one a lot. And a lot of it, unfortunately, is kind of voodoo. I mean, there are some strict margin requirements they're going to have out there depending on what type of margin they're working for. Is it portfolio margin? Is it going to be old school SPAN or things like that? And that's going to obviously have some requirements with it. But brokers will add their own flavors, their own nuances to this all the time, basing on your account size, how much you trade, how many clients you manage, that sort of thing. Also, maybe the type of trade it is and the product and the underlying could tie up more capital as a result. So it is a bit of a moving target there when you're talking about how much the broker is going to require. That's why I encourage you, if people have questions, or if you're managing clients' money through a particular portal and a particular custodian, you should contact them and say, if you have questions about that, how is this amount actually determined? I want to know exactly. Maybe sometimes you can get some relief on that front. But a lot to unpack here. Let's just go around the horn. Let's go reverse order. Maybe we'll start with the director of risk this time. Let's start with the first question, Chris. If you have any rule of thumbs for selling, he wants to sell 5 to 10% out of the money SPY puts on a regular basis. How much capital should he plan to put aside? And then B, if you have any thoughts on his question about will recent volatility spook the Fed? Have at it, sir.
It's a good question as far as how much money you have to set aside, especially when you're shorting premium. As a general rule, I always like to keep at least 50% in cash, and that's over and above your Reg T margin because, as you already mentioned, it is a moving target. It is going to ebb and flow, and so the last thing you want is to start getting margin calls on short put positions. I think other people would be a little bit more conservative and even keep up to 60% in cash. So it's kind of depending upon your risk tolerance, but I think as a general rule, 50% devoted to margin, what you have to put up front today to hold that position, and then another 50% in cash just to take some losses, be able to meet some margin calls, and then make sure that you're not going to get a notice the next day that you have to pony up extra money or anything like that. As far as the interest rate raises, I checked this right before Powell was speaking today, and it was still over 70% that they were going to raise in December. I don't think it's going to be recent market volatility that causes the Fed to reconsider its roadmap. I think it's going to be President Trump that makes them reconsider the roadmap, and I think you may have gotten some of that flavor today.
Yeah, he's not too happy with his nominee there. Yeah, go figure. The politicians, particularly populist ones, don't like it when you're dialing up the rates there. So yeah, that's why we never see rate hikes around Fed chairman renewal periods. Funny how that works. So yeah, but you're right. That might indeed be the driving force. Matt, same questions for you, sir. Do you have any rules of thumb for how much he should set aside when selling his SPY puts? And if you want to pontificate on the Fed and volatility as well, sir, feel free.
Yeah, I agree with Chris. You want to have a good amount of money, and especially when you're selling, and do it very conservatively. And then on the recent market volatility, yeah, we were actually asked by one of the wirehouses to opine on this and going into the G20 meeting and the Fed talking, and we're seeing. With the recent rise in the front month volatility versus, kind of its normal kind of declining over time relationship, that extra volatility in the market relates to about an extra 2% move for stocks over the next few weeks. And so there is a lot of volatility implied in the market over this recent kind of move downward. As far as what the Fed does, the Fed doesn't like, obviously, the volatility. And even after this kind of maybe somewhat dovish goings on surrounding the Fed today that lifted the market, the volatility is still there. So it didn't calm the markets from the option markets, what they're saying about future volatility. So, I do think the Fed looks at volatility. I don't think they like it. And there's some disagreement between our president and the Fed. So I think it could result later on in some dovish movement from the Fed, Mark.
Yeah, we don't usually see a president this outspoken on the Fed action, but again, you can say that for Trump about a lot of different positions. Outspoken is not something, or not outspoken, to use a double negative, is certainly not a thing people have ascribed to him in the past. John, you get final word on this one. Any thoughts for how much to put aside? Maybe you have your own kind of rule of thumb like Chris does when you're selling puts for clients. And also, B, if you have any thoughts on the broad Fed and the impact of volatility, have at it, sir.
Yep. I can tell you, we deal with this every day for clients. And so what we most commonly see at our level, and this is clients anywhere from our, high net worth retail clients to institutional, is they tend to be 100% collateralized. And really the reason for that is because, and Chris touched on this well, is that nobody wants margin calls every day. And so to be able to, in periods when markets tend to be more volatile and you're shorting puts, you increase those obligations to buy. And so should the markets move against you, you're getting knocks on the door from the likes of the brokerage houses to satisfy those margin requirements. And so to the extent that the capital is available, we do tend to see 100% collateralization on strategies. And then in regards to the Fed, I err almost in tandem with what Chris said. I think that the outspoken president is kind of seeing winning the battle right now with Powell.
A lot of our listeners probably don't want to hear that, the 50, 60, 100% collateralized. They like selling puts and the freedom that gives them a little bit. They don't want to tie down all that capital, but at the end of the day, it can be a beneficial thing as long as you know all the different ins and outs of that. Speaking of knowing the ins and outs, there's a related question here from Steve Giannakopoulos. It's quite a name. He wrote in not too long after our last show, and he seems certain that he has this great way, talking about writing puts, about how he should be able to do this with writing puts and how it should affect his margin in his account. I wrote to him directly. I tried to disabuse him of this notion, but he insists he is correct. So maybe Matt, I think maybe you could be the guy to help me disabuse him of this. His comes from Steve. Like I say, he says, seems right that you can write one put option when you already own 100 shares of the underlying stock. The brokerage can lock and keep the 100 shares as collateral instead of holding cash as collateral. He says it doesn't happen, though. Why? You could have your long 100 shares forced to sell at the put option strike if it's in the money and you get assigned. I read what you said. I just don't understand it. Thank you, though. So, Matt, clearly I failed to get through to this person and try to explain to them why holding stock and having a short put, the two things are not mutually offsetting. Maybe you could do a better job than I did here of explaining to Steve why you can't own stock and then sell a put and expect the broker to see those as offsetting, sir.
Yeah, when you're selling a put, and again, you went over the math earlier, so maybe that might help. A negative times a negative is a positive. So maybe you get back to him with basic math, Mark. And other than that, I don't have much to add on this one.
Yeah, unfortunately, basic math sometimes is hard. But it's a good question. I can see what he's trying to get at. But yeah, you have to have, I remember a put is an option to sell the underlying. If you're selling the put, you're giving someone else the option to sell the underlying to you. So if you have stock, you're now therefore agreeing to buy more stock. The broker is going to say, that's additive. That's not risk mitigating. And so they're going to make you tie up more margin for that put, not less. So, yeah, if you bought the put then you could look at your broker and say, these are offsetting positions. You should treat them as such. And most sane brokers should. If they don't, you should get the heck out of Dodge. But the other way around, no, they're not going to. They're not going to do that. Let's see. We'll go a little long because I like our listeners and we want to make sure we get a couple in extra. We got some long questions here. Those might be too long for the time we have left. There's so many good ones here. Let's see. This might be an interesting. We were talking about earnings before. This is an interesting one. This comes from SX78. We talked about earnings and we talked about Trump weighing in on things, and he has questions about both. SX78 wants to know, he says, now that Trump is weighing in on this earnings call thing, does this suddenly have legs? What will this mean for volatility going forward? If you guys weren't familiar, about a month, maybe a month and a half ago, maybe 2 months ago, I don't know, I think Buffett came out and a few others came out and said, these earnings calls around every season or so are really adding a lot of volatility to the marketplace. Maybe we should do away with them and maybe have it be every 6 months or every year, much fewer, far fewer in terms of the earnings information being distributed by the firm. And then Trump weighed in on it about a month ago as well. I forgot exactly what he said, but he seemed to be kind of a fan of getting away from that as well. So a lot of people in the option space were not surprisingly a little bit interested, or I know were concerned by that, because earnings season, whether you trade it or not, is a big driver of volatility, and volatility, I should say, is a big driver of options volume and options trading. So if earnings season went away, it might not be the best thing for the options market overall. So I'm kind of curious. I guess we'll go back to you, Matt, because this is kind of your neck of the woods here and what we were just talking about. Are you familiar with this? Do you think this movement, such as it is, has legs? It's got some big people behind it, Buffett and now Trump. And then C, do you think this will be the death knell for volatility for all of us?
Yeah, it's an interesting. I have been following it, of course, because I studied this way back in my graduate school of finance, and about what the decisions the CEOs had to make with their companies, looking at the quarterly earnings call. So, I think from an economic standpoint, it might add to actual valuations, and companies could start to make longer term plans. Does it have legs? It seems like this would be a big one to change. So much is behind it, and this is the first I've heard in 20 years of anyone mentioning that it should be spread out. What will it mean for volatility if something like this happens? Yeah, I think that volatility, you might get bigger moves in earnings because there's less visibility into companies. So it might cause actually bigger moves with less certainty in knowing what's going on with the companies. But you'll have fewer of these kind of quarterly earnings barrages of information. So that's how I look at it, Mark.
Yeah, it's a weird one. I'm kind of on both sides of that. Obviously, the option trader in me and the person who produces options content wants earnings season to stay around because it's a great driver for our audience and for the marketplace. But on the flip side, I can also see the argument of how it is somewhat disruptive to the overall markets. Maybe instead of spacing it out, maybe you have more frequent but far less impactful. Here's what's going on this week and that week. A little more, maybe more insight. Because I don't like the notion of firms dialing back transparency. That's not a good thing either. But having these regularly scheduled, effectively market-moving moments doesn't seem like the best scenario either. So maybe there is some room for some middle ground in there. All right, let's go let's end on this other one, because this is kind of a fun one. We had a similar question on another show, so I had a chance to weigh in on this one. So I'll save us some time, and I won't go on to this one. I'll let you guys have that. But it's a fun one. This version comes from Lizander, maybe Lizander. They want to know if you had to start over with learning about and trading options, what would you do differently? I think that's a fascinating question. I think all of us pretty much had the same route. We all came through the SIBO or another exchange as market makers, and that was kind of our starting points. We all kind of had a bit of a unique point of entry into the options space. But still, maybe there's ways you learned options that you probably would change, or maybe you think about it differently now that you have a few years of hindsight under your belt. Maybe John, we'll start with you. It's an interesting thought question. I don't know if you have an answer, but it's an interesting one. If you had to start over learning about and trading options, John, what would you do differently?
I think it's a great question, and of the four of us, I'm the only one who hasn't been on the floor. I
thought you were a SIBO guy as well.
Right, yeah. I started my career at a buy-side shop here in Chicago. So my answer is really simple. If I had to start over learning about options, I'd work for Matt Amberson and learn how to be a market maker. And so that's really it, plain and simple, Mark.
Not a bad answer. You take Matt's Gamma scalping course.
Exactly.
How to scalp Gamma intraday and actually make money at doing it, which it was always a challenge for me as a market maker. Let's go out to the director of risk, sir. If you, in your days before you were directing risk, when you were just learning this business, and you obviously spent some time, I think, with Saliba and his educational arm as well. So you have some experience on the educational side there. I'm curious, if you had to do it all over again, would you do it differently? And maybe not trajectory wise, maybe not starting on the floor, because that trajectory isn't really available anymore. But just how you learned, maybe would you tweak or change anything?
Yeah, I mean, I hate doing woulda, coulda, shoulda, but I definitely, like I said before, answering this question or a similar question, I was very fortunate with my trajectory. I think maybe I would have focused more on option portfolios. I mean, we talk a lot on this show about single strategies, but what happens when you start putting a Christmas tree with a call spread, with another put spread, with a caller, and start building these massive option portfolios? I think maybe I would have focused a little bit more on that at the beginning of my career instead of like studying just, single strategies in a vacuum.
Yeah, a lot of the things we did as market makers too are not that applicable, and especially people out there in retail accounts, they don't have the same margin access, they don't have the same capital, they don't have the same, they're not as focused on skew day to day as you were as market makers. So it's a very different, starting point for us versus a lot of people out there who started in a traditional retail account. And I mean, it's still the best way to learn options. I'm not going to back away from that. So coming through that kind of immersion, sink or swim type of environment, but it has sometimes some of the things you learn can have limited utility. I can understand that as well. Matt, since John wants to come learn with you, I'll give you final say on this one. What are your thoughts? If you had to do the whole shebang over again, what would you change?
Well, it says trading options, and John says come down on the floor. I was going to say go to work for John, so I would go work for John, and John would come work for me. So that kind of crosses each other out. No, I mean, I think that there's a big relearning that has to go on if you're a market maker. I mean, it's helped us a lot at ORATS because we could really look at the data and get the data right. But the whole back testing and looking at data and just looking at graphs and looking at graphs of data is really what I have had to do. I've had to unlearn a lot of what we learned on the floor, and in order to trade options, you have to really look at back tests. You have to really look at what option strategies work well in certain environments. I think that's one of the big things. So just getting a lot of data, testing it. That's how I would have wanted to learn how to trade options differently. So I don't know if John's hiring or not, but that's where I'd go, Mark.
It's a big love fest here on the old Advisors. Everyone wants to work with everybody else, so there we go. Except the director of risk. He's happy where he is. All right. That music means, unfortunately, we've come to the end of another epic episode of the Advisor. You guys can't complain. We did a whole huge Options 101 on stock replacement and getting long and short deltas. Answered a bunch of your questions, got some buzz. You guys got a mega episode this time, so hopefully you enjoyed it. Let us know if you did or you didn't. Of course, you got questions. You guys always send us those. Keep those coming. We love to hear from you. And before we go, let me go back around the horn. Let's go in reverse order once again. Let's start with John again. John, if people are interested in learning more about what you guys and your team are doing over there at Northern Trust and the options desk, where should they go? What should they do, sir?
Feel free to reach out, John_Cherry at ntrs.com.
Spelled like the fruit, like the man says in the intro. I like that. Cherry, Cherry. All right, and let's go around again to the aforementioned director of risk. Sir, people want to learn more about the DRS. They want to maybe attend one of your 10th box events. Maybe they want to check out the cool content you guys have cooking. Where should they go? What should they do, sir?
Yeah, we just put out a white paper about a month ago. It's called Know What You Own, Understanding the Diversity of Option Strategies. Talks a little bit about synthetics, which we touched on today, and then dives into the different types of strategies in Morningstar's options-based category. We just wrapped up all our 10th boxes for 2018, so be on the lookout for a new schedule coming out very soon. You can find that at 10thbox.com, 10thbox.com.
There you go. Check it out. The number 10thbox.com is the place to go for information on those events. If you're an advisor listening to the show, you want more education, chances are you'd be interested in an event like that. And chances are they probably have one near you. So check it out, 10thbox.com, or go to swanglobalinvestments.com for the great blog posts and white papers. And even have access to the show there. If you want to check out an archives, you can head on over there as well and do just that. And last but not least, Matt, we talked about a lot of your earnings reports. If people want to check those out, or maybe they want to hit you up for a back test, or maybe some of those models you mentioned earlier, where should they go? What should they do, sir?
Yeah, ORATS.com, Mark, and a great show. I mean, I wish I would have had this show when I was learning how to trade options. Great content. So another thing that we're working on is like I mentioned, just looking at option information in order to pick which type of an option environment we're in. And then we're able to now slot those into our back tests. So we're growing, lots going on at ORATS, so come on over, ORATS.com, Mark.
There you go. ORATS.com is the place to go. Give them a follow over there on Twitter as well, at OptionRats. Easy handle to remember over there. I like that one. And on behalf of Matt and Chris, a.k.a. the Director of Risk, and John, and indeed myself, I want to thank all of you for downloading, streaming, subscribing, for joining us live, for sending in questions, for all the fun stuff that you folks do. Keep it coming. And we'll see you next time for more of the Advisor's Option.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. The Advisor's Option is also brought to you by Northern Trust Capital Markets, offering a unique blend of transparent trading, quality execution, and smart liquidity solutions across institutional brokerage, transition management, securities lending, and foreign exchange. Northern Trust's options offering includes quiet access to non-traditional pockets of liquidity, with hands-on support from experienced traders to customize your trading strategy, combined with the peace of mind that comes with trading through a stable and globally respected firm. To learn more, contact John Cherry at John_Cherry, spelled like the fruit, at ntrs.com, or visit northerntrust.com/capital markets.